Alright, so what the fuck did Bernie Madoff actually do? He is, of course, most famous for running the largest Ponzi scheme in financial history, swindling investors out of as much as $65 billion, depending on who you ask. But how was that even possible? His fraud may be all he is remembered for today, but whether we would like to admit it or not, he changed the landscape of modern investing in more ways than we acknowledge. Ironically, had it not been for his Ponzi scheme, he may be remembered even less fondly for the other financial tools he pioneered, like payment for order flow, dark pools, online trading, FINRA, and the proliferation of hedge fund market makers. But perhaps more concerningly, his crimes also tell us a lot about the way our financial system operates to this day, which is revealed just by asking the most logical question: how did he think this was all going to end? He was a veteran of the financial industry, taking money off some of the richest and supposedly smartest investors in the world, running an operation that by its very nature was inherently unstable. It also raises the question of, what did his victims actually think they were investing in? The whole system was propped up on the three pillars of obscurity, ambiguity, and exclusivity, which are coincidentally very commonplace in a lot of the biggest firms today. Of course, nobody is saying that something like any of the several thousand private equity funds operating in America today are a Ponzi scheme. But the point is, if they were, it would be very hard to find out until it was too late. And these days, that might actually have real consequences. Perhaps the biggest irony in the Madoff story, though, is that despite being one of the largest frauds in financial history, it didn't really hurt any of its ultra-wealthy victims too badly. At least, not badly enough to enact any meaningful change. Good old Bernie exposed a lot of flaws in our system, and all of them were quickly glossed over as he was shipped off to prison. Nobody wants to learn from history when there is a profit to be made by forgetting it.
It's been 2.5 months since Bernard L. Madoff was picked up and charged with what's believed to be the largest financial fraud in history. We still don't know much more about the alleged $50 billion scam.
He was in the right settings, he played golf at the right places, he ate lunch at the right places, and he went to dinner with the right people. And what he did was, he was able to suck them in.
I read it, and then I read it again. It was like in shock, like non-believing shock. He couldn't possibly have, this isn't true. It's impossible to be true.
He had the patina of being a respected citizen, one of the most successful businessmen in New York, and certainly one of the most powerful men on Wall Street. You would never suspect him of fraud.
The beginning of Madoff's distinguished career was almost remarkably unremarkable. He came from a financially comfortable family and married into another financially comfortable family, but he was still expected to get his own start. While he was at university, he did what any student does. He took whatever job he could get. He worked as a lifeguard in the summers and installed sprinkler systems in people's yards. And he did it long enough that the paychecks actually brought in a meaningful amount of money. By the time he graduated, he had scraped together around $5,000 in savings, which, for a kid his age at the time, was pretty impressive, but still nowhere near start your own Wall Street firm money. For a moment, he did the respectable thing and went to law school, which is exactly what you're supposed to do if you want a safe professional career. But he found that arguing about money was far less interesting than actually making money. Because after a year, he dropped out and doubled down on the idea of starting his own business instead. $5,000 from lifeguarding only gets you so far, so he turned to the oldest form of seed funding and finance. He asked his father-in-law for a small loan of $50,000. So with roughly $55,000 in combined savings and family money, Bernard L. Madoff Investment Securities opened its door in 1960. Now at this time, Bernie wasn't managing money for ultra-wealthy families or running some mysterious hedge fund promising market-beating returns. He was effectively just doing the basic grunt work of finance, filling in cracks where he could find them. In the early years, Madoff was a market maker, mostly in tiny companies listed on what were called the pink sheets, trading stocks that, on a good day, might only see a handful of people actually buying or selling them. A market maker's job is pretty simple. You stand in the middle of other people's trades. You post a price you're willing to buy a stock at, and you post a price you're willing to sell it at. The margin between these two numbers is how you make your living. If somebody wants to sell quickly, they take your lower bid. If somebody wants to buy quickly, they pay your higher offer. And the gap in the middle, known as the spread, is where you get paid for providing this liquidity. If you've ever flipped items in RuneScape or EVE Online for a profit, you have effectively done what Madoff was doing for the first few years of his career. On a big exchange, with tight regulations and lots of competition, this is a boring, low-margin way to make a living. Spreads are typically small, information is widely available, and the system at least pretends to be fair. The pink sheets were not that. This was the part of the market where small, obscure, and sometimes questionable companies ended up when they couldn't meet the standards of the main exchanges, which meant fewer buyers, barely any regular trading, and almost no reliable information for anyone to work with. The name itself came from the daily pricing updates that the National Quotation Bureau would send out every day on cheap pink printer paper. And the fact that stock prices in these companies were only updated once a day should really tell you all you need to know about these kinds of operations. Prices in that world could be nudged around by a few aggressive brokers, a couple of phone calls, or a sales script that sounded convincing enough to someone who didn't know what they were buying. For comparison, share prices on modern, large, and well-regulated exchanges can often be updated by millions every second, so this kind of stock trading really was a different game. Of course, the name pink sheets may sound familiar to you because there was another infamous financial swindler who got his start doing the same thing about 2 decades later.
Name of the company, Aerotine International. It is a cutting-edge, high-tech firm out of the Midwest awaiting imminent patent approval on a next generation of radar detectors that have both huge military and civilian applications.
Now, to be clear, not everyone operating in this space was running a full-blown scam, but even the most honest players were working with a certain level of sleaze that was just baked into the business model. When you are the one posting the only real prices in a dark market that barely trades, you can quietly widen the spread, treat unsophisticated retail clients a little worse than your friends, or lean on information you got a few seconds before everyone else. And most of the time, nobody will ever know. This was the world Bernie Madoff learned in. Not a clean, well-lit trading floor with cameras, but the grey zone of the pink sheets, where prices were flexible, rules were fuzzy, and nobody looked too closely at how the money was actually being made. But a system like that was never going to stay invisible forever. Normally, this is where you'd expect the state to step in with a thick rulebook, and a regulator nobody can afford to ignore. But rather than building a powerful watchdog, the solution was effectively to hand the leash to the dog and say, well, you seem responsible, why don't you just supervise yourself? The result was the National Association of Securities Dealers, or the NASD, a self-regulatory organization set up so that brokers could effectively write the rulebook, enforce it on one another, and then present the results to the public as investor protection. On paper, the NASD was there to license brokers, inspect firms, investigate misconduct, and make sure that the kind of pink sheet shenanigans we just talked about didn't get completely out of hand. Over time, that structure was reshuffled and rebranded. The NASD's regulatory arm was merged with bits of the New York Stock Exchange's own enforcement division, and the combined entity became FINRA, the Financial Industry Regulatory Authority, the main organization that is supposed to keep American broker-dealers in line to this day. Whether or not it actually does is a problem we'll get into later in the video, but for now, know that Bernie Madoff was not some nervous outsider at odds with this system. His firm was a major member. He sat on NASD committees. He was treated as a model operator, exactly the kind of seasoned insider you ask for input when you're deciding how strict those rules should actually be. So the guy who learned his craft in the grey zone of the pink sheets didn't just survive the cleanup, he helped shape the body that was doing the cleaning. But even with that new respectable layer of regulatory involvement, he was still, at the end of the day, a broker competing for business against firms that actually had seats on the big stock exchanges. The traditional way to do that was to be on the floor yourself, jacket on, paper in hand, standing in a crowded room of sweaty men, shouting orders at one another and trying to get the attention of whoever was closest to the book. Instead of trying to win by shouting over everyone on the floor, Madoff started leaning heavily on computers to route and match orders instead of relying on runners, hand signals and phone calls. Now, give credit where credit is due, this was genuinely quite visionary. Back when computers still looked like this, he was already looking at the trading floor and deciding he'd rather have a screen to handle those conversations. Instead of throwing his orders into the chaos of the trading floor, he built systems that could quietly take in client orders, match buyers and sellers automatically, and send back confirmations without all of the theatre that went along with the traditional trading floor. This approach didn't just make life easier for his clients. It quietly turned his little brokerage into something that behaved a lot like a mini exchange. Orders came in, trades got matched, prices were quoted on screen instead of shouted across the room. And while all of this was happening, the NASD itself was trying to work out what the future of stock trading would look like. They saw that the old model of coloured jackets and hand signals wasn't going to scale forever, and they saw that what Madoff was doing looked a lot closer to where the industry was headed. So when they decided to build a market for its members that didn't rely on a physical trading put at all, they went down the same path, creating an electronic system that would publish quotes, match trades automatically, and let brokers plug in through their terminals instead of their vocal cords. They called it the National Association of Securities Dealers Automated Quotation System, mercifully known more commonly and simply as the NASDAQ. Over the next few years, this screen-based market stopped being a side project and quietly turned into one of the main ways trades in American stock were actually getting done. And Madoff's firm was doing a large amount of the volume on Wall Street. Bernard L. Madoff Investment Securities was routinely handling orders for big institutions, and the man who started out matching trades in obscure pink sheet companies was now presented as one of the people who understood the new electronic Wall Street better than most. Inside the NASD and NASDAQ world, his name was everywhere. He held senior positions, sat on committees, and in the early 1990s, he even served 3 one-year terms as chairman of the NASDAQ Stock Exchange. He was the man that stockbrokers put forward to reassure people that the market was in safe, experienced hands. Anyways, this is where the issue with self-regulation started to become obvious. Groups like FINRA and the exchanges were introduced as guardians of market integrity. But they were also industry clubs founded by member firms and staffed by people who moved back and forth between the regulator and the regulated, often within the same business day. Politically, it's sold as a win-win. It's cheaper for the taxpayer than building large, independent public regulators and actually funding them properly. And it sounds efficient because the people writing the rules supposedly understand how money works better than anyone else. In practice, even beyond the obvious problem of self-regulation, it creates other more subtle weaknesses. New firms and smaller players trying to do everything unconventional get put under the microscope in excruciating detail, while big, long-standing members that generate enormous volumes and fee income tend to be treated with a lot more patience and understanding. Firms like Madoff's. Now, to be fair to everything we've talked about so far, this is still the legitimate half of the Bernie Madoff story. The market making, the clever use of computers, the roles inside NASD and NASDAQ, none of that on its own is the Ponzi scheme. The uncomfortable part is that when you look at how his actual scam worked, the secrecy, the exclusivity, the lack of real oversight behind a very respectable public facade, you start to see patterns that look a lot less like a one-off crime and a lot more like a template that still exists in parts of modern finance today. So it's time to learn how history works, to look at how a supposedly safe, boring, well-connected firm managed to bolt a Ponzi scheme onto the side of its real business, and why the ingredients that made that possible are still very visible in some of the most fashionable investment structures operating right now. When you look at the Bernie Madoff story, the most interesting part is not just the fraud itself, but how long it went unquestioned. Smart people, sophisticated institutions, and regulators all missed the warning signs. That kind of failure is less about intelligence and more about how we reason, test assumptions, and evaluate evidence. That is why this episode is sponsored by Brilliant. Brilliant is all about helping you unlock the thinker you already are. Instead of memorizing facts, you learn through interactive problem solving that builds real understanding in math, science, and computer science. I have been spending time with their scientific thinking course, which focuses on how we form models, test ideas, and challenge assumptions. It is not a history course, but it sharpened the exact kind of reasoning that could have raised red flags in cases like Madoff. Working through it changed the way I look at claims and explanations. You start with simple logic challenges and gradually move into evaluating evidence, spotting weak arguments, and asking more precise questions. It feels surprisingly relevant and genuinely engaging. And since Brilliant personalizes your learning path, you always feel like you are moving at a pace that makes sense for you, with practice and reviews that adapt as you go. To learn for free on Brilliant for a full 30 days, go to brilliant.org/howhistoryworks, scan the QR code on screen, or click the link in the description. Brilliant is also giving our viewers 20% off an annual premium subscription, which gives you unlimited daily access to everything on Brilliant. Madoff's actual scam sat off to the side of all of this in what was officially called his investment advisory business, basically his asset management arm. This was the part of the firm that promised clients 10 to 20% returns regardless of market conditions. Now, anyone who knows the first thing about market returns will know that this is obviously just impossible. But crucially, Madoff was very selective about who he let in. You couldn't just fill out a form, wire money, and invest in his fund. You got introduced through a private bank, a charity board, or a friend at an exclusive golf club. That selectivity did a lot of heavy lifting. If access to something is scarce and everyone around you is impressed you're in, you are far less likely to start asking annoying questions like, where exactly is this money going? Or, can I see the trades? Madoff told people he was running a relatively conservative options strategy, buying a basket of large, well-known stocks and then using options to hedge the downside, which for anyone who didn't want to get into the weeds sounded sophisticated enough to be plausible and safe enough to be comforting. Clients got statements showing a neat staircase of positive monthly returns, very little volatility, and almost no visible connection to what the broader market was doing, which should have been a giant red flag, but instead became part of the sales pitch. Behind the scenes, there was no complex strategy. In most cases, there were no real trades at all. New money came in, old investors who wanted to withdraw were paid out, and whatever was left sat in bank accounts while the back office produced fake trade confirmations and account statements to keep everyone feeling calm. At one point, there was something like $5 billion just sitting in a regular JP Morgan bank account, not tucked away in some exotic offshore structure, just parked in plain sight because nobody was really looking. I almost wish there was some more technical deception behind the scenes to make it sound more interesting for the video, but that really was all there was to it. The only real cunning was in how he presented himself and his firm to supposedly sophisticated investors. But in that regard, there are still a lot of uncomfortable lessons that we have not learned from the Madoff story. Now, obviously, most modern investment firms are not running literal Ponzi schemes. And it would be ridiculous to say that every private equity fund is just Madoff with a PowerPoint. But once you see how his operation actually worked, it's hard not to notice a few uncomfortable similarities. Today, when people talk about alternative assets, they're usually talking about some version of the same basic idea. Raise a large pool of capital, buy real companies using a lot of borrowed money, tinker with the business for a few years, pay down some of the debt, and then sell the whole thing on for a higher price. The brochure version goes something like this. A fund buys a company, professionalizes management, cuts unnecessary costs, maybe nudges revenue higher, uses the extra cash flow to pay down the debt, and then exit at a better valuation because the business is supposedly healthier than it was before. There is nothing inherently illegal about that, and in plenty of cases it does exactly what it says. But it is a little strange that an entire industry can print very strong returns for long periods of time, mostly by refinancing balance sheets, shaving expenses, and passing the same assets from one fund to another. A lot of the performance in the middle is very hard to measure from the outside. Portfolio companies are private. Valuations are based on internal models. Numbers only get updated a few times a year, and there is no daily market price shouting at you when something goes wrong. You see a smooth line of reported returns, but you don't really see the path the companies took to get there. The exit routes make this even harder to ignore. A huge share of portfolio companies aren't sold to public markets or long-term industrial buyers. They're sold to other private equity firms that have just raised fresh capital and need somewhere to put it. One fund buys the business, pays down some debt, claims improvement, then passes it on at a higher multiple to the next fund, which might do exactly the same thing again a few years later. This does not make private equity a Ponzi scheme. The industry will be quick to point out that there are real assets, real employees, real cash flows. But at the same time, an industry like multi-level marketing will, similarly, claim they are not a pyramid scheme because they sell real products. The broad reality for private equity as an industry is that, over the last decade in particular, a lot of the impressive, predictable headline returns depended on new investor dollars coming into the system at higher entry prices so that the existing investors could cash out. Yes, there are more moving parts and actual businesses involved, but if the whole system is still reliant on new investors piling in, what would you call that? Now, maybe you still think it's different enough, and that's fine, but we've also made this much harder to monitor by putting it behind a regulatory wall. These funds only deal with institutions and sophisticated high net worth clients, which means lighter disclosure, fewer reporting requirements, and a general attitude from watchdogs of, well, they should have known what they were getting into. If you're a retail broker calling someone about a few $1,000s worth of listed stocks, FINRA will happily make you sit exams, get licensed, and live under a detailed rulebook. But if you're structuring billion-dollar buyout deals for teacher pension funds and family offices, most of what you do sits outside of FINRA's licensing regime entirely, simply because you're not technically selling securities to the general public. You see a similar pattern in private credit, which has grown into a kind of shadow banking system alongside all of this. Bespoke loans made by funds and direct lenders, negotiated in private with light covenants, optimistic assumptions about downturns, and positions that are marked to internal models rather than any real market. As long as the cycle cooperates, everything looks fine on paper. Yields are collected, new investments keep flowing in, marks are gently nudged upward, and nobody outside the inner circle has much visibility into the actual risks building up underneath. Which means frauds and bad bets can sit there undisturbed for a very long time before anyone realizes how big the hole really is. None of this is to say that private equity or private credit is just Madoff in disguise. The point is that we are still very comfortable with financial structures that are exclusive, opaque, lightly supervised, and extremely hostile to anyone who wants to take a proper look under the hood. And those are exactly the conditions which allowed Madoff's very simple fraud to survive as long as it did. In Madoff's case, the irony is that the headline number everyone remembers, that $65 billion, well, it was never real in the first place. That figure came from fake account statements and imaginary compounding, not from actual cash that went into the system. If you look at the money that actually went in, it was somewhere in the ballpark of $18 to $20 billion of principal. And after the dust settled, the trustees managed to claw back and distribute something like $15 billion of that to his investors. Which means that, on aggregate, this once-in-a-century fraud destroyed far less real wealth than the headline suggests. And most of the people involved were still comfortably rich afterwards, just slightly less rich than they thought they were on paper. The biggest irony of all of this, though, is that because his scheme fell apart in 2008, It was actually a better investment than a lot of other investment firms on Wall Street. Being in an outright Ponzi scheme run by Bernie Madoff meant only losing about 20% of your money at the time, when plenty of totally legitimate hedge funds, structured products, and bank balance sheets were blowing up entirely. Obviously, that doesn't make it right. A fraud is still a fraud, but it does underline how broken the wider system was. You could be in a complete lie and come out better than people who trusted products that were supposedly regulated, transparent, and run by some of the most respected names on Wall Street. And back then, most of the damage was contained to a fairly narrow slice of wealthy individuals, charities, and institutions who had chosen, voluntarily, to play in that exclusive little corner of the market. Ordinary households didn't wake up one morning to discover that their job, their home, and their pension were all secretly depending on whether Bernie Madoff could keep finding new money. Today, we may not be so lucky. A modern private equity fund still only takes money from rich clients and big institutions on the surface, but underneath that, a lot of those institutions are gambling with our retirement savings, which they use to buy up companies with real workers, real customers, and very real obligations to the communities they operate in. The same goes for private credit. Those alternative lenders are not just swapping paper with one another, they are deciding which businesses can roll their debt, which property developers can finish projects, and which firms have to start cutting staff when the next downturn shows up. If a system like that ever suffered a Madoff-sized honesty problem, or even just a prolonged period where everyone simultaneously realized the values they were throwing around were nonsense, the fallout wouldn't be a few embarrassed rich people quietly downsizing their yacht. It would mean layoffs, shuttered factories, unfinished housing projects, and pension funds scrambling to plug holes that nobody thought existed. In other words, we've rebuilt many of Madoff's favorite conditions: obscurity, ambiguity, exclusivity, and very light scrutiny for anyone dealing with sophisticated money. But this time, we've wired those conditions directly into the plumbing of the real economy. That's the part of the story that should worry us a lot more than the cartoon headline about $65 billion. The mechanics of this scam were simple, almost boring. The environment that let it run for decades is what matters, because that environment never really went away. It just moved into new products with better branding. And if you zoom out even further, you realize that none of this is especially new. Dressing up simple lies in complicated language, hiding risk behind social status, leaning on trust instead of verification. Humans have been doing that for as long as we've been swapping anything of value. Madoff wasn't some glitch in an otherwise perfect system. He was one very flashy example in an 8,000-year tradition of people discovering that if you mix a good story with enough opacity, you can separate other people from their wealth for an impressively long time. So if you want to see how deep that tradition really goes, from ancient merchants and medieval bankers, and maybe get a better sense of what the next version of this will look like, go and watch our video on the 8,000-year history of scams. And don't forget to like and subscribe to keep on learning how history works.